Kenneth, hi, good morning. Good to have you on the show once again. What are you feeling about the overall recovery that the market has seen? It's been a strong one, and it's good to see that off late there is that, sector churn which is happening. It's no more the reliance in the private banks. Newer sectors are participating in the rally. Gives you conviction?
The market is back, and we've seen that actually before the COVID event. It started off almost in January when the breadth of the market actually came back altogether. So markets have bounced back. Liquidity is flush within the system and outside it. Okay, and financial markets are holding up across the world. So liquidity will hold up the market till the recovery takes place. So I'm not. I mean, you will get intermittent corrections, but it all depends upon where we end up in FY22. And that's the year to watch. On the ongoing basis, I think the economy is crawling back across the world. You've seen the first round of recoveries come through. Let's go into the December and probably the March quarter. Things should hold up.
Sure. So what data points, Kenneth, when you are making your own market view, are you really keeping a check on, besides, of course, the liquidity and the FII buying that you're seeing right now? But besides that, for a meaningful recovery, to take that material call on sectors that are going to go beyond, the financial year and see a sustained recovery, what data points and what checkpoints do you keep on your radar?
I think firstly, there are two parts of the Indian economy as we see it right now. One is a domestic-driven economy that we've had extremely robust for the last 2 decades. First, it was driven by government spend, infrastructure, materials, and effectively the commodity boom that actually contributed to the first decade of that happening. The one that we left behind, it was consumer leverage, and that's where we are currently. The second part of the Indian economy was something that we haven't seen for a long time, is large companies getting a big footprint in the global arena. You've seen how IT has done it in the 90s. You've seen pharmaceutical achieve significant progress, and we are amongst the larger companies present across the world. You're seeing a lot of interest taking place in chemicals. I think as we go forward, you will continue to see, we've already seen that on the ground, actually. Companies have been getting a lot of inquiries. Companies with capacities have been getting a lot of inquiries from a very vast level of industry out there. If that continues to happen, I think India will bounce back, or Indian companies will bounce back more because they'll be able to utilize capacity for the global markets. The domestic environment tends to be will remain a little soft for a couple of years, my sense is. But corporate India, if it has the opportunity of going abroad and fitting into supply chains, I think that's what they will do.
Yeah, seems to be the case. But, Kenneth, on the point about the sectors which are holding out and which are showing you that long-term visibility, and I want to talk about IT right now. That's the sector where you can say at least the management commentary, the body language, all the data points are indicating that this sector is at least out of the woods, and it's showing you that kind of visibility that the managements as well are coming out and giving you that kind of guidance. So, clearly in that sense, there is some confidence that you have on the prospects of IT as a sector going forward. But again, the question that you're going to ask yourself is, that is the best and the easy money already behind you when it comes to the IT trade? Or do you think that this is a sector which is in a long-term
Kenneth, apologies for the technical disruptions, but I think Aisha was in the middle of asking you your outlook on those IT names.
When it comes to IT, I think it's a fairly mature business, but the whole decade that went by and is going by, the next cycle is all about digitization. The deal wins from some of these companies have been significant. The deal pipelines are significant, and this is in a quarter where things are slowing down. So it's definitely out of the woods. Growth seems to be coming back, and valuations are still fair. I mean, they're not expensive. On the point that you made, is the low-hanging fruits are behind us. I think with this bounce back in the market itself, a lot of the low-hanging fruits have gone in a lot of industries and sectors that are out there.
What about the pace of the recovery and in light of that, cyclicals, Kenneth? I want to get your view on that, because while we're not bearish, we're probably still going to take a while. Is this the right time to look at cyclicals?
So just let go of year 2021. I don't think you're going to have too much of, you're just going to wait till the cycle recovers in 2021, which is the financial year 2021. And you have to look at growth based on 2022 based on 2020. I think you will get that there. When it comes to commodities and materials and the cyclic commodities and materials business, you're seeing a bounce. Effectively, it's a trade that's happening because like all asset markets that sold up, this is also a segment of the market that slowed down. There are supply disruptions that are there sitting in the system. And because of that, there is some part of the market which is very buoyant, apart from what's happening with the US and the dollar. I think that's the trade that's playing out as far as the commodities are concerned. On the cyclical part of the world, automotives, construction, heavy engineering, etc. You will see a moderate recovery coming back in 2022. But the sense that we get, at least from the Indian context, that market could, with the domestic environment coming back to status quo and some part of capacity utilizations coming back, I think it's also a great trade. Net, and the cycle that's coming forward, or the couple of years that's going to come forward, and in 2022 we will realize a lot of that will just put us behind. I mean, 2021 will be put behind, and I think we'll recover. We will be much better off from 22 onwards.
So, Kenneth, the fact that there is a lot of interest, as you mentioned, in select pockets and stocks that's emerging, the overall, mood continues to be one that, where investors still want to get into this rally. They don't want to miss out, and equities are continuing to outperform. So in light of that, what are you really advising as a strategy? Does one, taking your view on the overall environment, but what is the kind of strategy you're recommending in terms of building a portfolio, or how much to be putting into equities currently?
Well, I can tell you what we are doing in equities. We've for a long period of time we haven't had financials and we hadn't had the consumer basket. We have a very valuation-based approach to the cycle, and when we look for growth, for us, it's the price that we pay for growth that is essentially establishes itself. So 2018, 2019, we didn't have too much of the financials and consumers. We still don't, and that's helped us recover significantly in 2020. Now going forward, our trade is fairly simple. Continue to look at the price at what you buy companies and businesses, and as soon as you allocate the caps, and when you've allocated capital into the cycle, just wait to watch execution as it comes off the ground. I don't think you're going to be disappointed in 2022. From an equity standpoint, currently it's the most unloved asset. What you're seeing happening in the environment is that money is getting out of equities and is going into other asset classes that are there. But I just advise investors to watch their asset allocation and don't skew away at any point in time to any to a very different asset class. I mean, just make sure that your asset, um, uh, yes, asset allocation is proper. Equities will do well. I mean, the breadth of the market is still significantly below 2017. The small cap indices and the mid cap indices have not done anything for a long period of time. Even on a 2-year basis, the large cap indices have not done too much. So you're essentially looking at the past and saying that 2 years there's been no return. But going forward, like I said, 2021 and 22, I think it's going to be a very different story for this asset class.
Right, Kenneth, morning. Wanted to just understand how you're looking at the kind of churn that we're seeing in the pharma sector, because there was that expectation that the sector would do well, and now you're seeing opportunity crop up, within different types of pharma companies. There's been a lot of mid-caps as well at the forefront that have proved their mettle. Do you think that this is just the beginning and that there's a long way to go by way of opportunity to be made within pharma?
Well, the low-hanging fruits are definitely out now. You only have to watch execution, how it goes. See, it's a crowded market out there, and some companies have done extremely well. What's happening in pharma is also happening in chemicals, and it's all happening in other industries. There's a lot of interest in industries which are which will get a large part of that will get relocated from the Chinese environment, and I think we're feeding into that system. So there is capacity on the ground, and there's significant capacity on the ground. These companies have been adding reasonable amount of capacities, and now the regulatory environment is in favor of these businesses. So that's what's happening on the ground. A lot of companies have been utilizing capacities. They will come back. You will see, and you have seen reasonably robust numbers that are there. You will continue to see it in FY21. And FY22, then you're working with a significantly larger base. Okay, so growth will come down, but it will still remain reasonably higher than what we've seen in the past. You also have to realize in pharmaceuticals that these companies haven't hit their peak in terms of profitability yet. Some of them are still far away from their peak in profitability.
And how are you looking at stock valuations at a time while deciding where one should be investing?
I think stock valuations are fair, given what's happened right now. A very large part of the market is still around book value. So I'm not very worried about stock valuations. The concern is still very macro-driven. Look, going into, and when it's going to be macro-driven, what we're seeing on the ground is interest rates have come up, and they come up quite considerably. You're seeing wage inflation off the table, given what has happened over the last 6 months. And the third cost structure, which has been very large for corporate India, has wage, interest costs, and electricity cost, power cost, and that's also going. And we are heading into a decade where electricity tariffs or power tariffs are going to only go downwards. So there's a lot of cost benefit that's coming into the next couple of years. If you can get that together, most of the companies are getting that together in terms of growth back into the cycle. I think it's going to be a very robust period between 2022 to 2025 in terms of profitability.
All right. Kenneth, request you to stay on with us. We have lots more that we'd like to hear out from you. Just let's slip into a very quick break.
For a new level of wild. Chaos on it. Coming soon.
Back with the market, still in conversation with Kenneth Andrade, breath holding out. The Nifty not. We are just quietly floating around that 11,158 odd level in the Nifty futures. Torrent Power is your big buzzer today. It's holding up almost 7.5%. Piramal Enterprises, Equitas, M&M Finance, Apollo Tires. It's an interesting mix of winners across the broader markets. Not such a great day for Lupin Idea. Both are reacting to their earnings. HCL Technologies, Infosys as well, easing out just that wee bit, and BHEL also, which is seeing a downtick of about 1.5% or so. But Kenneth, where are the newer opportunities to invest in the market now that you're seeing the participation kick in from the broader end of the markets as well?
I think you start with valuations first, and that's how we do it. Pick a couple of businesses and then look across the entire spectrum of that value chain. What's not happened in the past and where the capacity utilization is still sitting. Okay, you have not much has happened in utilities and in power companies. Okay, not much has happened in the automotive pack, especially with the CV guys. The same thing holds true for media, and there's not been too much of bounce back in numbers and in advertising in that part of the world. So when you go into a cycle like this, and if you're looking to play a contrarian, I think there are enough and more opportunities that are there, and that's at the bottom end of their life cycle. So things that are extremely robust at this point in time, obviously tech, pharmaceuticals, chemicals are doing very well. Manufacturing not so, but there are individual opportunities out there that you can go cherry picking. Financials, I mean, they tend to always have an issue, which is why we've never really allocated significant money out there. And consumers remain at the place where valuations are expensive. We don't know what's going to happen over the next couple of years, whether incomes can actually bounce back. So that's the part which is expensive, and there is growth, historical growth. We're not too sure is going to maintain that number. So that's the spectrum of the market that we get. So we put a trade together. You have to have a fair amount of contrarian ideas that are there at the bottom end of their industry cycle, and then obviously you've got businesses which are outbound, which is IT, pharmaceuticals, chemicals, and some part of manufacturing, wherein there is fair amount of momentum trade, a lot of inquiries on the ground for these businesses, and they could end up being reasonably having a reasonably large opportunity size that will emerge over the next couple of years.
Did you say power, Kenneth? And why is power as a space where investors haven't made money for decades is of interest to you?
It's actually the entire utility basket. So if you look at what's happening with India's basket of energy consumption, we are moving away from liquid fuels to gas and then electricity. The automotives globally, in another decade, you'll have a significant number of more electric-driven vehicles in the world compared to everything else you have. In India, it could be a function of gas or CNG, LNG, and power, electricity, and that's where some of the opportunities are there. But that's just one element of it. The second element is if the economy bounces back, the manufacturing opportunity holds out for a lot of corporates in India, then you will have reasonable amount of demand as far as that is concerned. But I think key to all of this is where valuations in this trade are. A lot of them are below book. Virtually all of them are below book currently. I'm not justifying that book value is fair trade because a lot of thermal power plants will not be around for too long. So the terminal value of a lot of power plants would be zero. But there is an opportunity for them to generate that cash flow. That cash flow is going to fund something out there. So you're going to get utilization coming back. At the front end, if manufacturing comes back, utilization will come back. Remember, industry is one of the largest consumer of power. And if the economic cycle bounces back, that's where your opportunity will be. In gas, while we don't have too many domestic supplies out there, there is if India goes to about 25% of gas consumption, or even 15-20% as some analysts have been talking about it, you've got monopolies sitting on the ground. You basically have 3 or 4 companies that will benefit from the expansion of volumes. So and they're not very expensive, given the growth that could happen with these companies. They're not very expensive. So you put it together, you got valuations, you got visibility of earnings that are there, and you've got monopolistic businesses that are sitting on the ground. The flip side of all of this is if you're playing the equity trade and manufacturing, in the India trade and
Thank you so much. Right. Right, Kenneth, we'll let you go on that note. Appreciate you taking the time out and joining us with your outlook on the markets. Always a pleasure having you on board.